Hello everyone. Hi everyone. How are you doing? It is amazing to come back again to talk to you. And I hope you all are well. You did well. And everybody is safe from COVID. And everybody is managing well. The countries have opened up. People are out on the streets. The governments have relaxed the lockdowns. And second wave, which came in many countries, it is being arrested by use of vaccines. I just hope all of you are safe and you did fine the entire last week. Now, today, I thought, what should I talk about? And I had three, four options. One option was to talk about network effect, about moats in the business, about platform effect, and all those things which we somehow we keep on hearing, but we are not able to understand much. The second option was to talk about how to raise funds, and that is a topic which excites a lot of people. And the third one is to talk about early stage investing by the use of Y Combinator safe notes. So I will discuss all these three topics today, the next week, and the next to next week. But for today, I will start by discussing the Y Combinator safe notes and how early stage investing can be done by using Y Combinator safe notes. I'll be sharing my screen, and so this is the presentation. Okay, so I hope everybody is able to see. So we are talking about safe notes, simple agreement for future equity. This is my mobile WhatsApp number and email ID. Uh, Y Combinator worked a lot in the area of simplifying early stage investing. So the problem with early stage investing is how to reach out an agreement between the founder and the investor, so that there is both of them agree to the nuances of the deal, to the finer points in the agreement. And it can be about valuation, it can be about the rights which the investor is getting. So I thought SAFE, which is simple agreement for future equity, is a very interesting piece of agreement, and large number of investors are not aware of SAFE, and hence I thought it is my responsibility to discuss more about SAFE today. What is SAFE? SAFE is simple agreement for future equity. It is an agreement between the company and the investor, and the investor, by signing the SAFE, he gets a right to purchase stock in the future whenever an investment happens in the company or a liquidity event happens. We say liquidity event like anybody putting money in the company, and the conditions under which this investment will happen in the company is set out in the SAFE agreement. The importance of SAFE during seed funding or preferred equity round, uh, the founders is often forced to set a valuation. Now, it is early stage. Suppose it is pre-revenue. The founder finds it very difficult to set a valuation, but because of the usual agreements, he's forced to set a valuation. But if he's signing a SAFE, then the value at which the investor invests, that is set in the future, whenever the next whenever an investment round happens in the company. Secondly, The preferred equity rounds uh, involves many legal documents. That is a hassle. SAFE is a very simple agreement. It is a one document security with limited negotiation terms. So this avoids the founder having to set a low valuation for their startup. It saves a lot of time and money. And the SAFE agreement, it does not have any date. So there is no maturity date. So what does SAFE mean? It means the investor takes preference shares in the company, which will be converted into equity at a valuation at which the next round of funding happens in the company, and a certain discount to it. The discount is usually between 5 to 30%. Usually it is 20%. Why investors prefer SAFE? It is simple. It saves time and money, and investors can have equity at a later date when the company is maturing and some investment comes in. And uh, and the safe notes holders, the investors, they can be entitled to better benefits in the future. But the negative points of safe, they are not an official debt instrument. So you can return the safe holders money back as a loan also, but that document is not an official debt instrument document, although the conditions of the nature of debt side are also written, and it's relatively new, so there is lack of familiarity. Third, dividends are not paid to safe holders the way they are paid to common shareholders. Fourth, there are some legal jargons. So don't worry about legal jargons. They are less than as many as they are in the common shareholder documents. Features: it requires less amount of time. There is no interest which is accrued. There is no maturity date. It is not a debt instrument. Type of safe notes. One, valuation cap, no discount. Valuation cap means that the investor writes a valuation number that the valuation wouldn't be higher than this. So the investor gets a benefit, and the founder also gets a benefit because the valuation is written there as a cap that it can't be more than this. The investor is more benefited. Then no discount. Uh, so there is no 5%, 20% discount. The second type of safe note is there is a discount, but there is no valuation cap. Third, there is a valuation cap and a discount. And the fourth is a MFN clause, most favored nation clause, and no valuation cap and no discount. Don't get confused. I will explain. Terms are safe. So, because investor is putting money today, but he's getting equity at a future date. So he's entitled to a discount. So this discount price is built, usually it is around 20%. Valuation cap sets the maximum price. As I said, that safe will convert into equity. And investor can get equity at the lower of these two things: the valuation cap, the number which is given, or the pre-money valuation in the subsequent round. So whichever is lower, the investor gets that benefit. But because it is a valuation cap, so many times the discount is not there. Most favored nation provision means that if in the future the securities, which is stock, is issued to any other investor in better terms, then the same terms will be given to the first investor, the investor who has signed the safe. So this is what is meant by most favored nation provision. Another term of safe is pro rata. So if you are invest right now, your preference share is getting converted into equity. Now, in the future rounds, the initial investor will get a right to invest more and retain his percentage shareholding, and by pro rata participating in the round. And but in the future rounds, he has to uh, take the equity at the valuation which is prevailing at that time, and not the current round. So this is about safe. Um so happy to answer any questions which come uh, on the screen, and I invite everyone to ask any questions about safe. Next, I will be discussing about some early stage startup valuations. Um I'll just share my screen. Okay. Now, these are some of the learnings from early stage investing. Rule of thumb. It works on rule of thumb. There is no fixed rule. It is more of an art than a science. Price is not always the value, which means that you might perceive your price as something else. I might perceive my price as something else. So there is, you know, to bring the both of them together is that's when the deal happens. But uh, it's not necessary that if you are quoting a price, then you know the value. Next, um, the entrepreneur wants the investor to value the company at high price, future value, and the investor wants to value the company at the modest current value. So investors always say, "What is the current business?" And the entrepreneur always says, "Look at the future, where we are going and what we are creating." So neither approach is right or wrong. Now, the important factors angel investors should consider while investing, that uh, we have to understand that two companies, one of them making profits, the other one making losses. The one with the profits is not growing very fast. The one with the losses is growing very fast. So if you are a VC and you were told that which one will you invest, so your any VC would say he will invest in the company which is growing fast and which is, even if it is loss making. So the reason, because the money being generated by the company is being put into expansion. That might be the reason why it is making losses, but at the same time, it has the potential to scale up, and maybe it has a unique intellectual property, and also that its product market fit is achieved. These are some of the examples of how uh, you know uh, those founders who have already achieved a handsome exit, when they start up again, what is the kind of valuation they get. Kunal Shah sold his company free charge to Snapdeal for, I think, $300 million. So when he started his new company Cred, he got $30 million as seed capital. Jitendra Gupta sold his fintech company to Naspers led PayU, and when he started Jupiter, he raised $24 million at $70 million valuation. So the investor is willing to bet his money, even at a seed stage, on those founders who have already done it. Sequoia led Series A round in Animal, and valuation jumps 7 times in 6 months. Now, every transaction is arbitrary because it depends on who you are talking to, whose point of view you are listening to. So, you know, how do investors value startups? Valuation, we talk about, let me give you the names of the type of valuations: net asset value, profit earning capacity value, transaction multiples, market multiples, discounted cash flow, uh, scorecard valuation methodology, then VC method. So all these are methods by which we value companies. Uh, Let me tell you in brief. There is another method called Dave Berkus method, but let me tell you in brief which one we work on and why we work on that. Market multiples. What does it mean? If a startup comes to me, right? If a startup comes to me and the startup wants to get itself valued, what I will do in market multiples is I will look at a similar type of company from the stock market, similar type of company. Now, whenever a company is listed in the stock market, all its data is on the public domain. It is given on the website, their financials, what is their revenue, what is their operating profit, what is their net profit. Also, because they are trading on the stock exchange, so the value of the shares, which means what is the market capitalization of the company, the value of the company. So I have the value of the company, I have the financial information about the company. So those companies which are similar to my startup, I will calculate their ratios. What is the value of those companies vis-a-vis their financials? And those ratios I will use on my startup because they are very similar companies. But because my startup is unlisted and there is hardly any liquidity available in the shares of my startup, and my startup is small as compared to the stock market listed companies, I will put discounts. Discount for liquidity, discount for size, discount for business dynamics. And the maximum discount which I can put usually is 50%. Any discount more than 50% means that it loses its significance. This is market multiples. Now, how do I do valuation based on transaction multiples? Now, my company has some other companies who are similar to my company, and investment happened in those companies. And the valuation at which the investment happened is given in some news reports in the public domain. Also, if you go to the MCA site, Ministry of Company Affairs, you can get the financial information of any company by paying a small amount, like $100. So you have similar companies like your company. You know the value at which the investment happened in that company. You have the financial information of that company from the company law website, company affairs website. So you can create ratios: the value of the company divided by revenue, value of the company divided by operating profit, value of the company divided by profit. And those ratios you can apply to your startup to value your startup because you know the financials of your startup. This is transaction multiples. So we have market multiples, we have transaction multiples. What is net asset value? Now, most of the startups, they are into asset light businesses, they are into technology. But whenever we value those companies which are asset heavy, like infrastructure companies, we use NAV, which is net asset value. And we measure the value of the assets in the company intangible, tangible. Intangible means like brand, um, the brand value, and tangible means real assets like real estate and machinery, and also cash and bank balance. And we add all of them up, and we get the net asset value. Net asset value valuation methodology is used mainly by real estate companies and by asset heavy companies like infrastructure companies. So we have covered market multiples, transaction multiples, and net asset value. Now, what is PECV? Profit earning capacity value. It means the last 3 years, what is the profit your company did? You create an average profit the company did, and you based on that profit number which you have, you calculate the price to earning multiple of comparable companies in the stock market, and you have that number, that how many times you have to multiply the profit to get the value of the company. So you have the average profit of the last 3 years, you have the ratio of company value divided by profit, use that to get your company value. This is PECV. That's a way to calculate the valuation of a company. So we have market multiples, transaction multiples, net asset value, and PECV. Now, let me bring you to the biggest one of them all. It is called discounted cash flow, DCF. What do you do in DCF? DCF is basically saying that we say that it is not the revenue, but the cash flows available to the company which matter for the valuation. And these cash flows, we create 5-year projections of the company. We see what is the net cash flows, which we call the free cash flows available to the company. uh, then beyond 5 years, we assume that the company will run for infinity at a very small growth rate, which we call the terminal growth rate. Now we have the value of 5-year net free cash flows, and we have the value of the terminal value of the company. So we have all those future cash flows. We have to bring the value of those future cash flows to current value, and that we do by dividing those cash flow numbers by cost of capital. Now, every company faces some unique cost of capital. It depends on the risk profile of the company. It also depends on the interest rates which are prevailing in country to country. What is the central bank treasury paper rate, interest rate? So every company potentially has a unique cost of capital. But because startups, they are kind of risky investments, because they are yet to scale, in most cases early stage. So the cost of capital usually number is high. It ranges from 25 to 40% uh, in Indian startups, which I have seen. So you divide the free cash flows by cost of capital, you get the discounted cash flow valuation of the company. So today we learned about Y Combinator safe notes, which is a very unique way of investing in early stage companies. We learned about valuation by market multiples, transaction multiples, PECV, profit earning capacity value, net asset value, and discounted cash flow. So next time we will learn about how to raise funds. It is an art, again, not a science. And also we will talk about a network effect, moats. We will talk about barriers to entry. We will talk about all such terms which startups and the ecosystem people, they keep on hearing, but it's always after a practical discussion that and examples that we get to understand these terms. So next time we will talk about them. Now, before going, I would like you to see this report. It's a report by Credit Suisse, and it did a research that last month in India, four companies became unicorns within a matter of 1 week. So, Credit Suisse has predicted in this report that India will have more than 100 unicorns very soon. And right now, there are 35 to 40, but it says that companies in e-commerce, payments, ride hailing, tech-enabled logistics, education, and SaaS, and all these sectors are seeing unicorns and will continue to see unicorns being created. And companies like Parley Products, Vishal Megamart, Wonder Cement, Renew Power Ventures, Serum Institute of India, and National Stock Exchange. And there are those companies who are probably currently valued more than 1 billion, but it's just that the funding hasn't happened at that valuation, but the potential value is more than 1 billion. And there are companies like Grow, Eruditus, social commerce firm Misho, content firm MX Player, and QR code aggregator Bharat Pay. So it's a very interesting report, Credit Suisse report. I wish India sees, and globally we see thousands of unicorns, and startup founders get their dreams come true. Uh, and let me name some of the unicorns which are given in this report. It's e-commerce, Book My Show, First Cry, Car Dekho, Cars 24, CureFit, Flipkart, Lenskart, Nika, Big Basket, Urban Company. Education, Byju's, Unacademy, Eruditus, Sri Chaitanya. Financials, Bharat Pay, BillDesk, Paytm, PhonePe, Pine Labs. It's an unending report. IT and technology, Citrus, Tech, Daily Hunt, Glance, Global Logic, Grey Orange, Headspin, InMovie, SaaS, browser stack, ChargeBee, Dhruva, Eightfold, Freshworks, Healthcare, Bharat Biotech, Hetero Labs, Anthem Biosciences, Manipal Hospitals, PharmEasy, Serum Institute, and discretionaries like Allied Blenders, D Decor, GRT Jewelers, Curl On, Rate Gain, Winnie Cosmetics, and Vishal Megamart. Logistics, Delivery, Ecom Express, SR Coach, Udan, Mobility, Ola, Ola Electric, Zoomcar, and others like Cement, Chemicals, Haldiram's, Policy Bazaar, and so on. So, with this, I end my show today. I hope we all discussed and learned about a lot about safe notes, Y Combinator safe notes, and also about valuations. Have a good day, friends. It is my pleasure to be on this show and to assist all of you and to guide with whichever way possible for me. Thank you and have a good day. Thank you, Abil Bek, as well. Thanks.